Good morning and welcome to the 2020 Master Trader Program Super Performance Workshop with Mark Minervini. I'm Bob Weissman, your host for today. This is day 4 of the workshop. This will include 4 sections in today's session, last about 4 hours total, and we will have 5-minute breaks in between each of the sections, along with probably a 10-minute break in between at the middle point. It's just to give you a little bit more time and a break there. Today's sections will begin on page 370, 362. Just a quick word. There is about 10 pages from 351 to 361. Those two sections are things that Mark will be going over tomorrow during the live training day. Remember, tomorrow does start at 8:30 a.m., which means we'll have the room open at 8 a.m. That will start the pre-market routine with Mark right into the opening bell at 9:30 Eastern and right through the closing bell at 4 o'clock Eastern. We do have a ton of questions that were submitted from yesterday that are being compiled for Mark to be able to have for tomorrow's session. If you do have any questions that you did want to write down purely from the material of yesterday or today, you will be able to do that here. Reference the page number first before your question, please. That's what allows Mark to really easily identify the question right with the page number. And again, we will have time to do that tomorrow. So we are gathering all the questions for that purpose. Also, if you do have any audio issues or video issues with today's session with Zoom, just log off, log back on. But so far all week, it has been working phenomenally with how many people we have here. The number of issues are it's just a few people, and it's a great, great quality product. So that will solve many of those problems. Other than that, we will get started now with day 4 of the Master Trader Program. This is Risk Management Part 1 on page 362 in your workbook.
Okay, welcome back everyone. 2020 Master Trader Program Super Performance Workshop. David Ryan is taking some time off here. Usually each year when we do the Master Trader Program, when we get to this section, I generally do this on my own. It's a pretty large section of the workshop. Sometimes I bring on some various guests on stage with me. Maybe we'll do that sometime along the line here over the next couple of hours. We're going to cover now risk management, which if you've read my first book, Trade Like a Stock Market Wizard, there's 2 chapters that are on risk management. So I obviously think risk management is really important, or I wouldn't have put a double chapter in my book. Now, the thing you got to realize is that when you're trading stocks, you're the manager. They don't have a manager. It's not like a mutual fund or a hedge fund. They don't manage themselves. You have to manage the stocks. Risk needs to be managed. And, this is really, we talked about, risk versus reward. We're going to get into that very deeply here and really discuss and have you understand risk and how to manage it and mitigate it. I'm going to tell you a story. You might have heard this before, but I'm going to tell it again. It's really important. When I first started trading, I would have some periods of success. Then I would end up giving back a lot of my gains. I would, blow myself up because I had some stocks that I held and I held them down and I didn't sell them and gave back my profits. So losses were a big problem for me. But at that time, I had just started trading. I wasn't sure what the problem was, but I had heard about loss cutting and I was trying to cut my losses. But every now and then, I'd fall in love with a stock. You've probably done that yourself. And I would hold it, or, it slipped real fast and I didn't want to admit that I made a mistake. And I'd wait for it to come back and say, if it just get back to break even, I'd sell it. And then it got deeper and deeper. So what I decided to do was I said, let me see mathematically if loss cutting really makes much of a difference. And I said, let me just pick an arbitrary number, 10%, and go back and look at all my trades and see if I had cut my loss at 10%, would it have changed my performance by very much? And that also meant taking my losses that were smaller than 10% and making them larger losses. So all my losses, whether they were 1%, 2%, 30%, they all went to 10%. So I ran the numbers, and it came out to where I had this huge increase in performance, so big that I couldn't believe it. I figured I must have made a mistake. So I reran the numbers. And this example right here that I'm showing you is not the exact, this isn't the exact numbers. There's actually more trades than 20 trades. Um, but it was it's a good representation, and the numbers are very close to what I had experienced. And basically, I had an average gain that was more than my average loss, and my batting average was about 50%. However, I was down about 12 or 15% at the time that from all those trades. And then what I did when I changed all my losses to 10% losses, um, all of a sudden I was at about an 80% gain. It was like a 95% improvement. And so there's a few things that are important about this. First of all, just by capping my losses, and I also checked to see if, survivorship bias, or if, some of the stocks, might have, hit the stop loss and then come back. So I checked all the numbers, and it really didn't make much of a difference. It was, no matter how you sliced it or diced it, if I cut those losses, my performance was much, much better. The real eye opener for me was that if you go and you take a look, and this example shows the difference between a losing trader, all right, after 20 trades, down 12%, versus those same exact trades, not changing anything with the the positions except where you cut the loss. Now almost an 80% gain. Look at the difference in the average gain stays exactly the same. The only thing that you're changing is the loss. And the loss goes from 15.9% to 10% on average. Not a big, huge difference, right? That's not a giant, it's not like there's this gigantic change. You cut the loss from 15.9 to 10%, and look at the difference in the performance. Now, these are numbers. This is math. Math doesn't lie. 1 + 1 = 2. You can run these numbers. I call this a loss adjustment exercise. You might get some very surprising results if you go and you do this to your own trades, especially if you're a losing trader. If you're losing money, or you have a period where you're losing, you do this exercise and you might have a real eye opener. So from this point on, I decided that I was never, ever letting a loss get larger than 10%. And 98% of the time, my losses are 7 or 8%, or no more than 7 or 8%, I should say. Actually, my average loss is usually about 5 or 6 over time. And in good markets, 3 or 4. So I made a decision. I drew a line in the sand, and I said, never again, unless the stock gaps and there's nothing I can do about it. But then I'm just selling it at the market right then and there and getting out and taking my loss. But over time, my average loss, I've never been anywhere near 10%, and that's been 30 years now. So why why are losses? And I'm sure you've seen some of these, these exercises or these numbers before. Most people know that losses work geometrically against you. If you don't, let's real quick just look at 3 key facts. Number one, you're definitely going to have losses. All right. You're not going to be correct all the time. If you're the best trader in the whole world, you're not going to be correct all the time. And you're going to have big losses if you don't cut them short when they're small losses. That's a guarantee. All right. You're not going to be correct all the time. 2, losses work geometrically against you. So the larger the loss, the more difficult it is to recoup. And the only protection against that is keeping your losses small before they get large. So real quick, if we take a look, there's a reason. Why do we want to cap our losses at, say, 8 or 10%? Well, there's 2 reasons. One is pure math. If you take a look, a 5% loss takes a 5.26% gain to break even. A 10% loss takes an 11% gain to get even. Now, as you go down the ladder here, 20, 25, 30, 43, oh, now you're starting to see a real differential. And when you get down to 50, if you let a stock drop 50%, it now has to double to get to break even. right? You have to double your account if you let it go down 50%. You have to double, the stock has to go from, if it went from 30 to 15, now to go back from 15 to 30, it has to double. So losses work geometrically against you. Now the math, if you see, once you start getting down to the 10% range, it's not an apples versus apples anymore. It's not where it's even. It starts to work against you. So that's why you don't want to get too far away from that 5 to 10% range, which is about 7, 8%. You don't want to get too far away from there, because now you've got to work harder to get that money back, right? So let's talk about risk versus reward. So when we talk about a 1R or a 3R or a 5R trade, we're talking about a multiple of risk. So let's just say you were to buy a stock, at $20, and you set a stop of, $1, we'll say, right? And the stock goes up $3. Okay, so you can call that a 3R trade, right? Your risk was $1. The stock is up 3 times your risk. So that would be a 3R trade. So let's look at 2 separate traders and see the first trader buys the stock, and both traders are buying the stock at the exact same point, right? The only difference is what they're allowing the stock to fluctuate and how much risk they're allowing. So trader A buys it as it breaks out, but the stock comes back in, right? And it goes down 20% or almost 20%, down to either whether that's your stop or you just don't have a stop. Comes down 20%, then turns around, goes back up, and trader A sells it at a 20% profit. So they risked 20% to gain 20%, right? That would be a 1R trade. You're risking the same amount that you're gaining. Now, trader B buys at the same point, only with this stock comes down 4 or 5%, or he's risking 4 or 5%. Stock turns around, moves up, nails down a profit at 20%. That's 4 times the 5% stop. So that's a 4R trade. Now, if these 2 traders are 50% correct over time, which trader do you want to bet on? The one that's getting 4 to 1 on his money, or the one that's getting 1 to 1 on his money? Some of you might have played poker, and if you understand poker and pot odds, this will make sense to you. So if you've got $500 in the pot and you bet into that pot on your hand, you bet $50, you're laying $50, right? You're laying $50 to get 500. That's a 10 to 1. You're getting 10 to 1 on your money. But if you were to bet $1,000 into that pot, you'd actually be laying odds. You wouldn't be getting odds. I should say, you wouldn't say you're laying, you're getting 10 to 1. But if you were to bet $1,000 into that pot, you'd be laying 2 to 1. The key with trading is to never lay odds. Never, ever lay odds. You always want to be getting odds. So at an absolute minimum, you want to be getting 2 to 1 on your money. So you want to be able to expect that over time, the trades that you're making, the risk that you're taking is half of the reward that you're going to be getting. Let me show you how this works in real life and show you how not all gains are created equal. Right? Just because you get a profit on a stock, it doesn't mean necessarily that you got there in a way that's going to work over time, or when you're taking too much risk. So trader A, this is just basically what we just looked at before, only with a real stock chart. Trader A risks 5%, right? Stock goes up 50%. That's 10 to 1. Okay, trader B buys over here and the stock immediately goes down. He goes through a 50% pullback and then celebrates when he makes himself a 50% profit. Well, he risked 50% for a 50% reward. Not to mention that 50% stock has to double, right? Just to get back to break even. So fortunately, this stock doubled and then went up 50% from his purchase price. But now that's only 1 to 1. He's not getting odds on his money. Again, which trader do you want to bet on? The one getting 10 to 1 on his money? And I'm going to show you why this is important. But first, let's talk about how not all gains are created equal, and the result doesn't necessarily justify the means. So I'll give you an example here. So 2 people are standing on the side of the road, and the first person, he looks carefully across the street. They're on the side of a highway. He looks both ways, and very carefully goes across the a highway and gets struck by a car, right? Is killed by a car. All right. The other person covers their eyes, covers their ears, and then blindly just runs into traffic and makes it to the other side safely. Now, what would happen if that scenario was repeated 100 times or 1,000 times? Which person would you bet on is going to make it to the other side safely on average over time? It's an easy answer, right? So that's the thing with trading. You got to realize that you're you're not going to make just one trade. You're going to make many trades over years, over decades, however long you're a stock trader. Even if it's for not a super long time, you're going to make a lot of trades. You're not going to make just one trade. So that result, if you're putting yourself in harm's way, eventually it's going to happen, right? So you can't. The rule is that you can't risk. You can't risk your portfolio. You can't risk a disaster that's so catastrophic that you can't recover from it. Okay, let's take another look at risk versus reward, and another reason why you want to get odds. All right, getting odds makes life so much easier, right? And again, by getting odds, you're not in control of how much a stock goes up, but you are in control of how much risk you take. So you can adjust that based on what your expected gain is. We're going to talk about how you calculate expected gain in a little bit. But the key is you want to act like an insurance company. See, an insurance company, what they do is they look at the mortality of the group of people that they're insuring. They have actuary tables, and they can predict over a large group of individuals that they're insuring. They can predict with incredible accuracy, on average, where those people are going to die and expire. They can't predict any one person very accurately, but as a group, over time, on average, they can come up with a number that's pretty much dead on. It's the same thing with trading. Like, I can tell you with very high degree of accuracy, right around where I'm going to be within probably 1% over time on my gains, on my average gain. Now, knowing that information, the insurance company now can set a premium, and they can set the level for what they're going to charge, and they know exactly how to set that spread, so they guarantee themselves a profit. The same exact thing is what you want to do with stocks. So once you know that number and you get an idea of what that number is, of what is your average gain is, that's just like knowing when the individuals are going to pass away, when your stock trades are going to pass away, when they're going to expire, and what gain you're going to be left over with on average. Now you can adjust that loss to know exactly where it should be. It becomes a mathematical calculation, right? If you're 50% right and your average gain is 15%, well, you know at 7% loss, you now are at 2-to-1. At a 5% loss, you're at 3-to-1. So now you have some control over the risk reward ratio. So getting your information is very powerful here. Getting your stats and your data and looking at your results, which we're going to cover in just a minute. I'm going to show you exactly how to calculate these things. But the reason why it's so important is it makes life so much easier. So if we look right here, if you're getting 1-to-1 and you're 50% correct, what does it take to break even? What rate do you need of win rate to break even? Well, 50-50 will break you even. Of course, minus if you had commission, you would lose. But without any kind of commission, we're talking about 50%, 50-50, you break even at 1-to-1, obviously. Now, what if you are getting the 2-to-1 on your money, right? What if you're getting odds? Well, if you're getting odds and you're getting 2-to-1 on your money, well, at 33%, if you're right only 3.3 times out of 10 times, or 33 out of 100 trades, you're breaking even. You're not losing money. So you don't get yourself into trouble, even if you're only right 33% of the time. Now, if you're getting 3-to-1 on your money, you can be right only 25% of the time and not get in trouble. You're still breaking even. And at 5-to-1, 17, 10-to-1, 9%, and it goes all the way to where it gets better and better, of course. The larger your R is, okay, the larger R trade you have, the less times you have to be right to make money. If you go the opposite direction, if you're laying odds, well, if you're giving 2 to 1, you could be right 67% of the time and you're just breaking even. If you're laying 3 to 1, you could be right 75% of the time. You're still not making any money. This is why you always want to get odds. You never want to lay odds. So what exactly do you control? That's the key. The key is to have, when you're managing risk, we have to think about, we want to mitigate risk. So how do we do that? Well, we obviously have to be in control of something to be able to control it, to be able to control risk. We have to be in control of something, right? So what are we in direct control of, and what do we have no control over? So first of all, we have no control over how much the stock is going to go up. The profitability, we have no idea. That's just an assumption. And so, and the frequency, the amount of times that we win versus we lose, we don't have any control over that. Okay, these are just assumptions. So we have to find out with those numbers. We're dealing with probabilities. Now, direct control, we have what we buy, when we buy it, how much we buy, position sizing, and when you sell. So you have control over a handful of things. The key is that these things that you have control over, that's where you want to really concentrate your attention on and perfecting those decisions, because that is what's going to determine your success. Now, the question is, how do we get control over the things that we don't have control over? So how much the stock goes up, the frequency of wins. How do we control that? How do we get some kind of handle on that so that doesn't just go haywire and tank our portfolio? Well, there's a very simple way. Okay, do you know the answer? You probably don't know the answer, because the answer is not to rely upon it. That's the key. The key to controlling things that you don't control is not to rely upon them. All right, we're going to rely upon the things that we don't control as little as possible. Let me show you what this means. And this is the concept that I call building in failure. And very simply, it just means that we want to have our stock trading, or in our system, if you want to call it, we want to have it where we've built in a lot of trouble. So if we were to not have a successful, streak in the market, we have a losing streak, or we're not right very, very often, it's not going to blow us up. Now, I've studied these numbers inside and out over 35 years now, 37 years in the market. And we found that there's some things that you want to rely upon more heavily than others, even when sometimes the math will fool you. And you'll think that, well, okay, it's basically the same thing. Okay, so let's take a look here on this first example. So we have two traders, trader A and trader B. So the net result from these two traders is the same. After 10 trades, they're up 28% after 10 trades. Well, trader A, though, is getting his edge from his risk reward ratio. All right, he's getting, and I say he, it could be a she too. Matter of fact, she's usually trade better than he. So I'm finding that women are great traders, and we've had lots and lots of women traders come into the Master Trader Program, more every year. So I'm happy to see that. I say he. I don't want to sound sexist. Average gain is 15%. Average loss 5. That's a ratio of 3 to 1. Batting average 40%. So out of those 10 trades, 4 of them were profitable, 6 of them were losers. Okay, trader B has a complete inverse risk reward ratio as trader A. His average gain is 7.5%, and his average loss is 15. So he's 2 to 1 risk versus reward, right? Negative R, a ratio of 0.5. However, his batting average is 80%. So 8 of his trades are winners, 2 are losers. Net result the same. So you would say, well, what does it matter, right? If they're still getting the same result, this person's a better stock picker, and this person is better at managing the risk. Okay, but here's the problem. What if something goes wrong? And something will go wrong, believe me. There'll be a bear market. There'll be a streak where you will have a losing streak. This is where we get into what's called risk of ruin. Risk of ruin is how long can you go? How many trades can you make? How much pressure can you take before you either blow your account up or get into serious trouble? So we found that risk of ruin, when you rely on batting average versus risk reward, risk of ruin can rear its head in a much uglier way and faster. Let me show you how that works. So now what we're going to do is we're going to take trader A and we're going to cut his edge in half. His edge was his risk reward. So we're going to make the risk reward go from 3 to 1 to 1.5 to 1. So now the average gain is 7.5% and the average loss is 5%, right? Just a little bit more than the loss. Same batting average, 40% batting average. Now adjusted for the batting average is 1 to 1, right? So basically about a break even after 10 trades loses 2%. Now, trader B, we keep the same average gain, average loss because his edge was on the batting average, but we're going to cut, like we cut trader A's edge in half, we're going to cut trader B's edge in half and cut it to 40% from 80. So now he's got 4 winning trades and 6 losers. Okay, look after 10 trades, what happens? 57% loss. Big difference, right? Okay, so maybe you say to yourself, well, we weren't very fair to trader B. That's a pretty big drop, 80 to 40. So, all right, let's look at another scenario. Let's say this time we're going to be a little more lenient on trader B and a little harder on trader A. So trader A, we now have a 7.5% gain, 5% loss. Like before, we cut the win-loss ratio in half, but we're also going to take the batting average down. We're going to take the batting average now from 40%, 4 out of 10 winning trades, to only 30%. So now only 3 out of 10 trades. Now after 10 trades, we have a 13% loss, right? That's trader A. Well, trader B, we're going to leave everything the same and just cut his edge by only 1/4. So we're going to take the 80% batting average and just bring it down to 60. Not much, a huge change. Still 10 trades, 20% loss every 10 trades. So a big differential, all right? You still, after penalizing trader A quite a bit on both his edge and the batting average, still trader B is at a disadvantage. All right, let's take a look here and we'll try another scenario. So this time we have the same situation as before. We're going to keep trader A the same with that 13% loss, but this time we're going to double the average gain. So make it even, right? Instead of a 7.5% gain, we're going to double it and make a 15% gain. So now losses are the same as wins, and we're going to take the batting average to 40%. 10 trades is a 42% loss now. All right, now you can do this math yourself. You see, however you slice it or dice it, trader B is at a disadvantage when he loses his edge, especially if he starts losing, more than his edge, more than just the batting average, which for any trader is going to happen. In a tough period, your losses are going to be larger, your gains are going to be smaller, your batting average is going to be lower. So you want to control risk through the best possible way, that when things go wrong, that you're going to keep yourself afloat even in the worst case scenario. So the bottom line is that losses are a function of expected gain. We're going to go back to the insurance scenario, right, with the actuary tables, and how insurance companies figure out where the average person is going to pass away, and then they can adjust their premium. It's the same thing. Think of the premium as your losses, where you're adjusting your stop based on where your trades expire. All right. So if you know that number, it becomes a mathematical equation. And this is the holy grail. The holy grail to trading is managing the risk reward relationship. Average gain times percentage of winning trades divided by average loss times percentage of losing trades gives you your adjusted win loss ratio. All right. So if your win loss ratio is 50-50, you're right 50% of the time, and it's in your gains are 2 times your loss, you're going to have a 2-to-1, right? But let's say your gain to loss is 3-to-1, but your batting average is 40%. Same 2-to-1. You're still a 2-to-1 trader. That's your adjusted win loss ratio. That's the holy grail. Okay. And the key is that you have to get those numbers and start calculating and figuring out what's going on in your trading. You have to know the truth about your trading. If you don't know the truth about your trading, it's like flying a plane without looking at the instrument panel, and flying a plane in the dark with clouds and rain without looking at the instrument panel and wind. That's a bear market. Um, you have to know these numbers. And when we do the live event, I ask the audience, I say, show of hands, how many people right now know their average gain, their average loss, and their batting average? Show of hands. And usually a very small percentage, 5 to 15% maybe raise their hand. Most people don't know that number. And then usually, if the people who do raise their hand, I'll say, okay, right there, Mike, what's your numbers? And then some of them won't even know, and they raise their hand. So we have a piece of software when you subscribe to our members, my Intervening Private Access membership. There's some software in there that you put your trades in, and it will calculate these numbers for you. You can use a spreadsheet. You don't need the software. You can use an Excel spreadsheet. But how I calculate it, and how I track it is on a monthly basis. And you can see here, this is just tracking average gain, average loss, largest gain, largest loss, average gain, average days, number of days held for the gain, and the days for the losses. These are your important numbers that you want to track. Let me explain each one of them. We talked about the average gain and the average loss. Okay. It's important to take a look at that on overall basis, on lifetime, or at least a few years, over hundreds of trades, thousands of trades, whatever that may be. Also on a monthly basis, as you're looking at it monthly, you can see when things are running a lot better than maybe some other months. You can actually see trends, and you can see when your loss is ballooning and your average gain is shrinking. Now, of course, you want to see that on average. And in some months, you might have where your average loss is bigger than your average gain, and your batting average isn't very good. That's going to happen. But over time, everything is all about what you do on average. Your returns are all going to be based on where your average gain is and your average loss is, and how that's managed over time. Now, you also want to look at your largest gain and your largest loss every month. So in this particular month, let's look at February. In February here, and I got little tools that I can use to highlight this stuff. So in February right here, we had 8 trades, right? Average gain was 17.51, average loss 5.35. The largest gain was 21.34%. Give me a little spotlight here. And the largest loss was 8.15. So that's good. The gain was largest gain was larger than the largest loss. Now, that's not going to happen every month, okay? But over 6 months, 12 months, you calculate that on average, it better be where you have at least a 2R, right? 10% average largest gain, 5% average loss. That should not be inverted, all right? You definitely should not have your loss be larger than your gain on the largest gain versus the largest loss over any period of time from 6 months on. Now, otherwise, that just shows that you're letting your losses balloon, and you're letting your gains, you're clipping your gains off, but you're not containing your largest losses. On average, you want your average loss to be smaller than your average gain, and you want your largest loss to be smaller than your largest gain. Now, if we come over here and we take a look at the average days held, you want to also look at the number of days that you've held the winners versus you've held the losers. The reason why is if this number is inverted and you're not holding a longer, you don't see a longer number for hold time for your gains versus your losses, well, that tells you that you're stubbornly holding on to losses, right? And you're giving up you're getting rid of your gains quickly. That's the exact opposite, right? You've heard this over and over. Let your winners run, cut your losses and let your winners run. Well, this is how you find out if you're doing that. Your number of days, if you're letting your winners run longer than you're holding your losses, well, then you're going to see it. You're going to see there's going to be an average. Your average is going to be longer. Now, in any 1 month, it might not be. Over 6 months, 12 months, they should never be inverted. So when you look at all these different numbers and you really start to get a picture now of what type of trading you're doing, and you will immediately know what's going on in your trading. This is your instrument panel. All I have to do is look at these numbers of a trader. I'll tell you everything about that trader and what they're going to produce. And I only need a short, maybe 6 months or a year of data, and I know everything I need to know. Whether they're someone who stubbornly holds on to the losses and they let stock losses balloon, or if they're giving back a lot of their gains, you're going to see that all in your numbers. Now, oops, let me just go down here. This is what I call your personal bell curve. All right. Everything is going to come on a bell curve. All your trades are going to distribute over a bell curve, right? Gains being to the right, losses being to the left. Now, you may have some outliers. You're going to have some gaps. You're going to have some stocks that get away from you occasionally. And you'll have some outliers on the left side. You're also going to have some outliers on the right side, some stocks that were very big gains. So the key is that you want a skewed curve. You want that curve to be skewed to the right. The majority of your losses should really be hump in that left side close to the zero line. And then all your gains will distribute out to the right further than the left. Now, very simply, again, another tool that we use in our own software is that we have what's a tool called result-based assumption forecast, or RBAF, we call it, where you could put in these numbers and see exactly how many trades it's going to take to get to your goal. So if your average gain is X and your average loss, your batting average, you put those numbers in. So we call it the hopper. We put them in the hopper, and then it will tell you, okay, you have to do 134 trades here. If your average gain is 12%, your average loss is 6%, your batting average is 50%, your position sizing is 25%. Okay, it's going to take you 134 trades to get to 100% return. You know exactly what you need to do. And your question is, how long is it going to take you to get to 134 trades? Is that something that's doable in 6 months, a year? If that was 1,340 trades, well, that might not be something that's doable. Now your numbers need to change. So you can change those numbers. If you do this in a spreadsheet, or if you use our software, you can change the numbers and see how it affects the outcome. All right. Now, you might be asking, well, how do we know that average gain? If we don't control that, how do we know that average gain? So that's where your results come in. It's really important that you base all your numbers on your own results, not back testing or someone else's results or what the strategy produces, what you have produced. Let me tell you why your own results are so important. See, the strategy is only as good as your discipline to execute it. And each person is different. Some people are very nervous and jumpy and can't hold a stock very long. Some people are very relaxed and they can hold a stock for a lot longer and give it a lot of fluctuation room. There's other people that they get greedy and they have gains and they don't sell them and they give them back. There's other people who can't ever get a big gain because the minute they get a small profit, they can't help themselves from selling it and taking it. There's people who let losses run and don't cut their losses and double up on those losses and end up taking big drawdowns. There's all types of personalities and traders, and your results are going to be the net of the strategy and your personality, your idiosyncrasies, your own emotions that override the strategy. So it's really a pure net number. So there's two ways that you can or there's some two ways that people will use, and normally most people use a theoretical assumption where they're basing, their risk reward based on an idea, a projection, maybe a target. Like on Twitter, a lot of people always say, "What's your target on this stock?" I don't have a target. Okay. My target is, or what I base my risk on is what I have produced on average. See, I'm going right back to that actuary table. I'm doing exactly what the insurance company does. I'm looking at on my bell curve where my gains expire on average. And that's where I'm going to set my loss at a fraction of that. So that's what we call a result-based assumption, or what I call a result-based assumption. A lot of these terms you hear, you won't hear anywhere else because they're I termed them, I coined them. Result-based assumption forecast is one of them, where I use results, my own personal results, to make my assumptions, and I build everything around that. Now, so a theoretical assumption might be where, okay, maybe you look at the chart and it's gone down 10 points in the deepest part of the cup. It's a cup with a handle, and then it breaks out. So you use a swing method and you say, okay, well, they can go up 10 points from here. But that doesn't mean anything because that stock might not do that in the first place. But the main thing is you may never let it get to that, just purely on your own type of trading or your personality. Maybe you're a short-term trader. So, and you're not good at that. So, or maybe a lot of stocks do go up, but you give those profits back and you're not good at nailing them down and executing. There's a lot of things that could go wrong, or that can happen, that you're going to override the strategy, even if it does produce the results that you've assumed based on the technical analysis or the math. The real thing that is about as true as can be is the results that you're actually producing. So if you were to say, well, on a theoretical based assumption, I think the stock's going to go up 20%, and you set your stop at 10%, you're essentially having a 2-to-1, but that might be a false 2-to-1. In reality, maybe you only have a 10%. So now you would be 1-to-1 and you wouldn't make any money. And you're scratching your head, why don't I make any money? Well, because your assumption's wrong. So with a result-based assumption, I'm using my real life results, and now I'm using a 5% stop because I have a 10% gain. Now that's a 2-to-1. That's a real 2-to-1, at least up until now. If I change things, could it change? Sure. But after you trade for an extended period of time, you're going to find that that number is going to really start that number is going to start being really reliable. As long as you're executing a strategy that's consistent. I mean, if you're doing options one day and you're trading stocks the next, and yes, there's going to be a big fluctuation in that. We're talking about strategy specific numbers. If you were doing an options, you'd run different numbers. You would keep a separate calculation for that. So the key is that knowing the truth about your trading allows you to manage the risks correctly. All right. If you don't even know these numbers, how could you even know how much risk you should take? I mean, there's no way of knowing. You're just purely guessing. As you see, as we go along here, you're going to see that there's no stone that I leave unturned. I know everything that I need to know about my trading. I know everything that's going on in my trading. As much as I know a lot about technical analysis and I know what to expect from my strategy, the math behind it, the risk, the reward, what I'm producing with my own trading, and how many days I'm holding my gains versus my losses, and my average gain versus my largest gain versus my largest loss. All this information, I know it all. And I'm in touch with it. And the key is, I'm going to show you how to take that information and take it from the spreadsheet and bring it into your real life trading. This is where it gets really, really interesting, where you're going to actually bring this data into your daily trading and your daily trading decisions. So with what you've learned so far, we know that losses work geometrically against you, and that we want to keep that risk reward ratio where you are operating at a multiple of your risk, right? So some of you might have seen this before, and of course, many of these examples are in my book as well, or in my books. But I want to go through this again and take a look here. If you had a 4% profit and a 2% loss at a 40% batting average, you would produce a 3.63% profit in 10 trades. So now it makes sense that if you were to double your gain, you could double your loss, right? So you double your gain to 8%, you double your loss to 4%, you're still at that 2-to-1, right? 40% batting average. Now 10 trades, those same 10 trades are going to give you a 6.49% profit. So let's double it again. We're going to double the gain and we're going to double the loss, maintaining that 2-to-1 reward to risk ratio. So we bring it to 12-to-6. Now we make 8.55% on 10 trades. So we double it again. 20% versus 10. That produces a 10.2%. So now it makes sense that if we keep doubling this, as long as we maintain that 2-to-1, we're going to keep having bigger numbers, right? Right? Wrong. Okay, so now at 42% versus 21%, we're still at 2-to-1, right? And at 80 versus 40, we're still at 2-to-1. So what would those numbers be? So let's take a look. And we talked about how not all gains are created equal. Not all ratios are created equal. All right, the 2-to-1 doesn't mean anything at a certain point if you're only 40% batting average. Once you go below a 50% batting average, which you will at some point in time, you will go below a 40% batting average, you get negative expectancy. The higher that ratio goes up, you hit negative expectancy quicker and quicker as the batting average goes down, and you will hit negative expectancy no matter how much you bring that ratio up. So there's a peak, there's an optimum ratio. In this particular, at 40% batting average, your optimum ratio is 20-10. Any more, any less than 20-10, you make less, you have less return. And as you go to the right of that curve, you go into negative expectancy. So now at a batting average of 40%, you would come here. Let me get my little tool here so you can see what I'm looking at. So where do we go? We raised it up to 21 and 42, right? Yep, 21 and 42. So right here. So at a 40% batting average, you actually start losing money. If your batting average slips to 30%, you lose 45%, right? So now let's look at, we moved up also, what was it, 80-40, 80-40. So again, now at a 40% batting average, you've doubled it all the way from 10 to 20, right? To 80-40, you now lose 51% of your money at a 40% batting average. And at a 30% batting average, you lose 83.67% of your money in 10 trades. In 10 trades. See risk of ruin? This would be ruin pretty quickly. And you're still maintaining that 2-to-1. So what does this mean? It means that losses work geometrically against you. And there's optimum ratios, and you need to know that. You need to know the math behind your trading, because what seems logical may not be very logical when you look at the math behind it, because losses work geometrically against you. And once you fall below 50% batting average, you can't allow for bigger losses, even for bigger gains. Now, the real reality of it is that when your trading gets into trouble and you go into a bear market and you're a correction, your losses are going to get larger, but your gains are going to actually get smaller. So even if you maintain the same ratio, you would lose money at some point if your batting average is dropping, even if you maintain that same ratio, but you're not going to maintain that same. It's going to be even worse because your gains are going to be smaller and your losses are going to be larger. So it's even more important. So I want to show you another example. I'm trying to drive home a point, and right about now, you should have some aha moments. This is where usually when we do this live, I look into the audience, and it's dead silence, and everybody looks like there were a deer caught in headlights. This is where everybody's just catatonic now, going, whoa. And these are the numbers, all right? This is the math behind it. So I want to show you another example that illustrates risk versus reward and how important it is that the key is that you have to have a multiple of your risk. You got to be operating where your risk is less than your reward. Okay, we can't stress this anymore. This is really, the main point here. So we looked at it trade by trade, but let's look at it another way. Okay, here's another example I'm going to give you. So you've got a 3-year return set, right? And I'm going to give you the choice of having either a fixed number of anywhere between 10 and 90% per year. And you choose which one, whether it's 10, 10, 10, 20, 20, 20. Two of the years are going to be gains. So if you pick 20, it would be 20% winning year, 20% winning year, 20% losing year. And it doesn't matter which order. It could be 20, 20, 10, 20, I'm sorry, 20 profit, 20 lost, 20 profit, or 2020 with a 20% loss in the third year. You're compounding, so it doesn't matter the order of them. So, but you're going to have 2 years that are profitable and 1 year that is unprofitable or negative, the same percentage as all years, right? So what would you pick? What would your pick be if I gave you that choice? Well, the optimal, the best pick that you can make would be 30, 30, 30. And that would give you a 3-year total return of 18.3% or 5.8% per year. Not a very good return, right? I mean, that's not even worth trading stocks for 5.8%. That's if you were up 30% 1 year, up 30% the second year, and down 30%. So you ask yourself, well, I don't understand. How could I be up 30% 2 years and down 30% only 1 year and only be up such a small amount? Because losses work geometrically against you. And as you move up that scale or down that scale, there's an optimal ratio. You go less, you make less. You go more, you make less. Right? So at some point you hit negative expectancy. So you come here at 70, 70, 70, you're losing money now. And at 90, 90, 90, you lose almost 30%. So no matter how you slice or dice these numbers, you've got to be operating where you're managing the risk reward relationship. Okay. So, and what this means is, and when you're trading, and at some point, things are going to, the wheels are going to come off the wagon at some point, and maybe a lot sooner than later for some of you that are just starting this. You might be in a great market and still have trouble because you're just not experienced yet. But I can assure you when the market's tough, even for myself and for seasoned traders, you're going to hit periods where your batting average is very low and adjustments need to be made. And what happens is a lot of people adjust for volatility and they adjust down. They widen their stops. They use ATR, all right, which is the worst thing in the world you could ever use. ATR will eventually blow you up if you're using it in this type of trading. Because you're allowing the volatility to dictate your risk, and that's okay if you want to allow it to dictate it, but you've got to allow it to dictate it where you tighten your stops. You give less room instead of more. Now, when you're not trading well, the first thing you want to do is get off a margin. That's the very first. If you're using margin, get off of margin, raise cash, reduce your exposure, reduce your position sizing, and be less forgiving. All right. So when I am trading and things aren't going well, I'm going to be very tight, and I'm going to give very little room for my stocks. I'm not going to be forgiving at all. I'm going to be very stringent, and I'm going to make sure everything's perfect. But then when things are going really well, I might be forgiving. I might be a little more sloppy in my technical analysis, and I might allow a stock maybe to have a little bit more room because things are going well and I'm going to get bailed out. This is the exact opposite of what most people do. What happens most of the time when things are going well, they take their profits quick. And when things aren't going very well, they hold their losses, pray that they come back and get into a lot of trouble and widen their risk in volatile times. You want to do just the opposite. Tighten your stops, be less greedy, and settle for smaller profits. If things are going well, then you want to go for bigger gains. But if things aren't going well, now you've got to tighten things up. Now, if your gains are smaller, well, then your risk got to be smaller, right? You got to tighten your stops. So these numbers work together. I'm going to show you in when we talk about position sizing, the relationship between these numbers and how when you move one, how they affect each other. That's a little later when we get into position sizing. Now, what happens is some people say, well, just this one time, I'm going to break my rule. I'm going to hold for a bigger gain. I'm going to double down here. I know the market's coming back. You've got to ask yourself, because just this one time is never just this one time. It's a very slippery slope. I don't know anybody who breaks their discipline just once. If you break your discipline once, you break it 10 times. You break it 10 times, you break it 100 times. It's a slippery slope, and you've got to get to a point where there are no just this one times. Until you get to that, you're not, in my opinion, you're not a pro. You're not a pro. Pros are disciplined and they're consistent. So you have to ask yourself a very sobering question. How many times do I have a just this one time moment? And you're going to find out that the answer to that, you're probably not going to be too happy with, if you're honest. All right. Now, if you're having trouble trading, you want to troubleshoot right away. There can only be two things wrong. One of two things or both. Either your criteria is flawed and the general market's fine, or you're executing properly, your criteria is good, and the general market's not good. And it's just not a time where you should be aggressive in the market. Now, people ask a lot of times, well, how do you know, the market's not good here, or you've called for a top, and I've had a lot of great market calls. Well, because my criteria is solid. I know my criteria is good. So that leaves only one other moving part. If my criteria is good and I'm executing the trades perfectly, if I'm not making money, then the market's no good. It's not a healthy market. It's a very simple deduction that I make, and that has kept me on the right and wrong side of trading for the last 3 decades. And if you followed me, I've called virtually every market turn within sometimes right to within a day or so of a high, all based on just how the stocks are acting. And if I have good criteria, then I know the market's not good if I'm having trouble. So your trading failures are going to stem from two things, either faulty principles or faulty discipline. You could have a great strategy, but if you're not following it and you don't have discipline, it doesn't matter how good the strategy is, right? And it doesn't matter how good your discipline is if you got a crappy strategy. You could be the most disciplined trader in the world, but if you're executing a strategy that doesn't have an edge and isn't profitable, then you're not going to do too well. So the key is to measure all these numbers in your own trading, and then you use those as a guide. And the benefit of this is that you're going to find right away that you're going to make better assumptions when you use your results. They're going to be real assumptions that you can count on, a lot more than just an assumption based on technical analysis or a guess or a target. You're going to optimize your loss cutting. Now you're going to be cutting your losses at somewhere that makes mathematical sense, that actually has some basis behind it. Now you're averaging 10%, your batting average is 45%. Well, you obviously know that you can't have 10% losses, right? You've honed that down now. You're going to make better risk reward decisions. You're going to improve your decisiveness. You're going to make very decisive decisions because you're going to know the numbers. And this is where the numbers and the spreadsheet comes into your trading. I'm going to show you how you bring that into your trading. Very simple. The next time that you're about to make a trade and you're about to make a trading decision, you ask yourself a very simple question. How is this going to look on my spreadsheet? So let me explain how that works. So let's say that you have a loss. It's at 5%, right? And if you know your numbers, you know your average gain. Your average gain, let's say, is 10%. So at 5% stocks down, you say to yourself, okay, that's I'm 2-1. This is an acceptable risk. What happens if that loss goes to 10%, which many of you, I always ask for a show of hands here. How many people have had a 10% loss? Now the whole room raises their hands. How many people had a 20% loss? 80% of the room. How many? A 50% of loss? 50% of the room. I mean, surely not an 80% loss or 90. Yeah, still a handful of people. So when you get to that number, you're going to automatically bang, the warning light, bang, bang, the warning light goes off. Warning, warning. I'm getting to the point where now I'm past my average gain. Now, you see, now the spreadsheet and the numbers have made their way into your trading, into your daily decisions. You are now cognizant and you know where you were and where you're supposed to be. So, and then if you're following these numbers and you're putting them down and you're looking at that bell curve and you should make a bell curve. We have that in our software. We have a physical bell curve. Once you make that trade, you take that big loss on that side of the bell curve, you're going to see that outlier pop up. Bingo, there it is. Hello, that's the decision I made. That's a crappy decision I made. You're going to have to live with that, right? If you're honest and you're going to keep all your numbers, you're going to see it. So now while you're making the trades, you're cognizant. You say that number's too big. It doesn't make mathematical sense, and that's going to be sticking way out on the left side of my bell curve. Your trading will change so dramatically once you do make this change. It'll be life changing. Okay, so we're going to take a break here, and then I'm going to come back. Risk management. There's still a lot to go over, but this was the first venture into it, and we'll be back in a little bit. All right, take a break.
Okay, guys, that was part one. I can already tell from the number of comments in the chat that this is already very meaningful content for you. This is just part one of 3 parts of risk management. So let's take a 5-minute break here, get a breath, do your jumping jacks, get the blood pumping, get a little drink or food, bathroom break, whatever you need. And I wish I could just see all your faces because every year this is where the jaws drop. One quick note, when Mark talked about the having the number of hands raised, who knows their numbers and their stats, the number of hands that were raised in uh, the number of you that raised your hands was also very similar to what the live event would be, very small. So let's take a few minutes break here. We'll get started with risk management part 2 in just a moment.